Good afternoon, ladies and gentlemen. Great to have you here for ActivTrades Monday Market Matters session this afternoon for 3rd of April 2023. Sorry, we had a little technology challenge there, so I do apologise there. You know, there's with the best will in the world, but we're here now. Okay, and that's the important thing. All right, so we're here, good to go. Hopefully, you can hear me. I'm hoping that you can see the slide, because today, as it says, we're going to talk about how to best use moving averages in our trading. A very simple trading tool that is often misunderstood or often misused, and hopefully during this session we'll be able to sort of just help traders just of all sort of all levels just to understand them a little bit better and how you could actually utilize them in your own trading. So without further ado, why don't we move on to the rest of our session for today. As always, okay, we just start with a quick risk disclaimer. I hope you can read that. Just remember that trading on a margin does involve a degree of risk, and that you are responsible for your own trading choices. So, where should we go today? Well, unsurprisingly, for those of you joining us for the first time, we'll have a little chat about Monday Market Matters and talk about the news coming this week. We'll talk a little bit about, well, what are moving averages and what do we need to be aware of when utilizing them? And most importantly, how can they benefit us as traders? What could we do to utilize them better as a tool to help us in our own trading endeavors? And then if there's time, what we'll do is we'll have a little look at the live market, see what's going on as we get into the start of the US trading session, and have a little look at what, if anything, the moving averages are telling us at this moment. So, for those of you who don't know me, my name's Paul. Traded for many years. All right, traded for funds, traded for clients. Primarily, I focus on FX, indices, and commodities within my own trading. I tend to be a trend trader for longer term, for swing and position trades, and I tend to be a reversal trader for shorter term trading. That's my particular style. For those of you joining us for the first time, Monday Market Matters is our start of the week webinar, helping us just basically get ourselves set for the opening of the US market and the sort of the start of the trading week. So each Monday, 2 p.m. London time, we'll always cover things like the news, what's coming up this week, a little bit always on education. Okay, what can you do to utilize and help you in terms of building your own trading knowledge? We'll have always a look at some of the tools that are available to you as ActivTrades clients. We'll have a little look at the markets as we go into the start of the US session. So, as always, let's start with having a quick chat about the news. We're into a kind of an interesting period here because, Friday saw the end of the first quarter of 2023, and a very interesting quarter in what I've always said is going to be an interesting year. So today we're into the start of Q2, but also these first couple of weeks of April can sometimes be sometimes it can be a little bit skittish, and what I mean by that is just that very often we're going into a seasonal holiday period. For over here in like kind of the UK and Western Europe, we're going into like a Easter period, and so sometimes an awful lot of people can be away on holidays, but there is still a lot of news coming out. We're still getting the start of quarter, all right. So this week coming ahead, we've got US PMIs this afternoon, okay, at about 3 o'clock, and I think that will probably have an impact on the start of the US markets this week. We've got an awful lot of PMIs coming out. I think we've got the services PMI on Wednesday, all right. Japan, you can see there, Japan, Spain, Switzerland, Italy, France, Germany, the EU, UK, Canada, and the US. There's a slew of it coming out, and people will be very keen to sort of see what that comes from it. We'll also have the Royal Bank of Australia and the Royal Bank of New Zealand. They will have their monetary policy meetings this week, and at the moment both are expected to sort of see interest rate rises, and we will wait to see A, if that happens, and B, what's the kind of associated commentary with that to give traders a hint on what's the likely future trajectory. And then, of course, this week on Friday, even though it's a bank holiday in some parts of the world, what you'll find is, of course, it's first Friday of the month, so it is non-farm payrolls. So As I say every week, if you're a new trader, I don't expect you to be able to provide in-depth analysis of these news events, but it is important for you to know when they are coming out. You'll find with an economic calendar on the ActivTrades website, and there's economic calendars all over the internet as well. So there's no excuse not to be able to understand when the big news is coming out, because you want to be prepared accordingly for when that news comes out. So let's dig into what our deep dive is for today's Monday Market Matters educational element. And as I said, today we're going to talk about how best to use moving averages. And as the slide says, for many new traders, moving averages are a simple and popular indicator. Well, why are they popular? Well, we'll take a little look over the next few slides as to why. But what I would say, my own personal belief is that many new traders use them inefficiently in their own trading. And as I said, in this session, we'll take a little bit of a deep dive into that and discuss how traders can use them more efficiently in their own trading styles. So as it says, many traders will start their trading journey begin using moving average indicators. And why is that? What makes them popular? Well, for starters, they're very popular because they are a visual trading tool. And rightly or wrongly, okay, we still live in a world where most traders are male, and most males are driven by visual cues, rightly or wrongly about that, ladies and gentlemen. Okay, that's what they do, and it's one of the reasons that they are popular, and it allows traders to view smoothed out data. And this becomes more interesting for, let's say, for new traders in terms of the way they interpret moving averages and actually how they look to use them. So, all a moving average is if you're completely new to trading, is that at the close of each candle, of each bar, then what will happen is a moving average. It's, if in this particular case is a 10-period moving average, so you'll hear traders refer to it as a 10 MA. All right, that will effectively take the last 10 closes, add them up, take an average of that, and print that average. And what we see is a 10-period moving average is, you can see the blue line there, is actually quite close to the price. And what will happen, as we'll look at in a couple of slides' time, depending upon how much data goes into that, will depend upon how reflective that moving average is. So the smaller the number, the more the less data there is. The bigger the number, and you'll see traders using 200. I've seen them using 800 period moving averages. Well, of course, there's more data to go in, and so invariably it doesn't move as quickly as the price does. And there's as we'll see, it's almost a little bit of work needs to be done to understand which moving average suits your style of trading best, but also suits the particular market that you're operating in. What they can be very useful for, moving averages, is they can be very useful to help traders, especially at the start of their journey, where they may not necessarily have fully developed abilities to analyze markets or to read price action, but it helps them gauge the direction of the market, the momentum, and also the strength of the particular trend. So here we go. In this particular example here, we've got this is a 20-period moving average, a 50, and a 200. And most, let's say, accomplished traders would be able to recognize that that is clearly an uptrend. We're getting higher highs and higher lows. But I understand, when you're a new trader and you're just trying to build a little bit of belief, you build a little bit of confidence, a little bit of trust in yourself, being able to even just recognize, that when the price is in an uptrend, when price is above the 50 and the 200, is a simple filter. Okay, it's a simple way to basically filter in or out particular markets in terms of what you're looking to trade, and that can help a new trader. And until you develop the sort of the not only the skills in reading price action, but also just developing the confidence and self-belief and trust, and and that's very often overlooked. Right, for many traders, that's often overlooked, but actually is unbelievably important. So when we start to look at moving averages, the first question becomes, well, what type of moving average should I use? And you will find there is, a huge array and range and option of different types of moving averages, all of them available on the ActivTrades platforms, whether it be ActivTrader, whether it be MT5, whether it be MT4, and they're all on there. And I'll show you where they are on the MetaTrader platforms when we switch across to the live charts. But what you will be met with is options, and as I said, these days there are quite a lot of different types of moving averages. But really, what you'll find is most people, will work on either using an SMA, which is a simple moving average, or an EMA, which is an exponential moving average. And what's the difference between them? Well, as it says, in simple terms, speed. We see is that exponential moving averages, they tend to give more weight to the most recent price action. So when price changes direction, the EMA recognizes this sooner, and we'll talk about that a little bit more. However, the simple moving average, which moves slower, will keep you in trades longer when you are trying to follow a trend. So what we have here in this chart here, what I've plotted is I plotted a dotted blue line, which is a 20-period EMA, and a standard blue, which is a simple moving average. So as I said, exponential gives more weight to the most recent price action, whereas a simple moving average, as the name implies, it simply just adds up the last 20 closes and then variably takes an average of that and plots that. So what we see here in this particular example is that you can see for a lot of the time they're actually very similar. Excuse my drawing skills, but as the price here bottoms out and turns, we can see that basically the EMA starts to turn quicker than it does for the SMA. But the SMA sort of turns slower, but it basically keeps it in that sort of downtrend until it's finally confirmed that it has reversed, whereas we've started to get these higher lows. So as I said, because it adds more weight to the most recent price action, the EMA is probably more it's more suited, all right, in terms to certain types of trading styles, whereas the simple moving average is, as the name implies, it's a simple one that when you're in a good trend will help you stay with that a little bit longer. And as it says there, even just being able to understand the differences between the 20 EMA and the 20 SMA, for some traders that in itself can be a trader idea in there in itself. That can be utilized to just as simple as that, as those differences between those. I know of traders who will just utilize that themselves in their own particular trading style. So, if we're deciding what type of moving average, and you will find that for me, I mostly use just SMAs, simple moving averages. There's no kind of perfection when it comes to the type of moving average. All right, there's nothing wrong with exponential moving averages at all whatsoever. I just tend to use, for the most of my trading, simple moving averages. If you're looking then you're looking, well, what is the best period moving average? That's the next question you're going to find traders asking yourself. And as it says there, it is a bit of an age-old question, one that's been debated down the ages. And in reality, if you have the time and the skills, you could spend your whole life testing combinations of different period moving averages. And I know of traders who will do that. My suggestion, and what I utilize myself, is just stick to the commonly used moving averages. And why would that be? Is because actually they become a bit of a self-fulfilling prophecy, and we'll see that as we look into charts more and more over the next few slides, and then when we go on to the live charts. What we'll very often see is that people will use variations on a theme of sort of 10-period moving averages and below will be utilized for shorter term trading. The sort of 20 to 21 can be a very effective filter for the short term trend in terms of it changing or supporting it. The 50-period moving average, all right, is very often used as a kind of a medium term trend, or more importantly perhaps a definition of fair value, and I'll show you that in a slide or two's time what I mean by that. And then really anything sort of like kind of the 100-period moving average and above, and particularly the 200, etc., they're used for identifying the longer term trend. And it is that relationship between all those period moving averages that starts to get people interested. It's also people utilize it in terms of their own trading, and it's also where people can sometimes get a little bit, making poor trading choices based on that, rather than understanding what's truly going on in the market. But we'll talk more about that in a moment. So what you will always see on my charts is, I was saying that I like to utilize just simple moving averages. So on my charts, I have a blue 20 period moving average, a red 50 period moving average, and a green 200 period moving average. I will sometimes have a 12 exponential moving averages for intraday trading, but generally as a rule, these are pretty standard 20, 50, 200. They are very standard moving averages, and as I said, they become a little bit of a self-fulfilling prophecy. And as I go deeper into how to best use moving averages, you'll see why I particularly am quite comfortable and quite happy with those. As I said, you could spend your time curve fitting moving average to each individual instrument. And I know of traders who do that, and you may have the time and the skills to be able to want to do that. And there's absolutely nothing wrong with that, ladies and gentlemen. It's just that I find that the 20 and the 50 and the 200 are perfectly good enough for what I'm looking to utilize on my from my charts and trading choices. Well, and then of course, once we've decided what type of MAs and what best periods we're going to use, then we're going to look at, well, how can I use moving averages in my trading? What is it that how can I utilize them to help me? And there are actually many ways to identify trade opportunities using moving averages. And so we'll have a little look at a couple of them, and I'll show you the kind of the pros and the cons. There's never, as I said, there's never any perfection when it comes to trading like that. It is always a case of, all of them have their pros and cons. I would always share with you, that they all have their pros and cons. There's no perfection. It's about which one best suit you in terms of your own particular trading style, and we'll talk a bit more about that now. So the first way that many people will use moving averages is, and you will hear them talk about utilizing moving average crossovers. And it's a very popular trading strategy with new traders because it's deemed to be visual, it's deemed to be simple, it's deemed to be easy. And you're basically placing a trade when the faster moving average crosses a slower one in the direction of the cross. And it can work very well in trending markets, all right, but very poorly in consolidating markets. And we'll look at that now. It does work well in trending markets, but the truth is pretty much everything works well in trending markets, you will learn. Furthermore, markets don't trend as much as we would like. Generally, markets may only trend 20 to 30% of the time. And that is where moving average crossovers can sort of, get people into a little bit of trouble. So, of course, what people normally see at the store, or, what they understand is that, they just literally, once let's say the fast 20 period moving average crosses the 50, the slower 50 period moving average, and once it crosses there, well, then you're looking to to buy that market. You're looking to trade in the direction of the cross, and so of course you're buying in here, and then you wait and stay with that trade until basically the moving average crosses back against you here. Okay, and so of course it looks very simple and very easy to basically to get in there and get out there, and and that's a fabulous trend trade. Okay, and everybody's very happy, and that puts a smile on everybody's face, right? And that's not that's not it's not not a surprise. Okay, that's if trading was always that easy, everybody would do it. Okay, but the reality is that as I said, in trending markets, everything tends to work very, very well. The challenge you have is in terms of trading moving average crossovers is the reality is, as I said, markets don't trend as much as as we would like, and so you can do very well in trending markets, but then invariably you can basically give back those gains, all right, in a range bound market where invariably you're just getting what they call whipsawed. You're getting chopped in and out trying to buy and sell when a market is going sideways, and that is the challenge with using moving average crossovers, all right, just using them just in the most simplest form like that. Okay, that they work very, very well in trending markets, but very, very poorly in range bound markets, and most of the time most of those markets are range bound. Okay, so just want want to make you aware of that. It's not so you can't utilize them. You can indeed, but just be aware of the kind of the best market environments and conditions to trade them through. And what you will quite often see in the media is, one of the reasons, maybe moving average crossovers do sort of get attention, okay, in the media is that you will hear, if you watch some of the financial media, you'll hear them talk about what's often called a death cross, which is where the 50-period moving average crosses the 200-period moving average to the downside. Or a golden cross where the 50-period moving average crosses the 200-period to the upside. Okay, and you'll hear that talked about quite a lot in the media. But personally, I don't personally believe them to be useful trading indicators, as you can see in both of these cases. All right, here, and then let's just clear this down. In terms of the death cross here, well, actually, you can see that the market had already been in a downtrend for a very, very long time. Okay, before the 50 had crossed the 200. Remember, moving averages is always going to be a lagging indicator, and the bigger the numbers that you're utilizing, well, then the slower, okay, the slower they are, the bigger the lag. And on the flip side, okay, in terms of the golden cross here, which is here, but actually, you can see that the price had bottomed out and reversed and had already been in quite a trend before effectively the golden cross occurred. So, they are very popular on financial media because it's easy for people to see. But my own personal opinion is, people talking about death cross and golden crosses as kind of trading signals. I don't particularly hold much sway. They don't hold any sway with me. Okay, that's not the way. But it's good for you to know what is out there, and for new traders, what happens when people talk about these things. So where can be useful is using moving averages as a trailing stop loss for traders. All right, and this is a good example of where moving averages can help you, and to have a simple way to trail your stop in order to stay with winning trades for longer. And depending upon whether you're a shorter term or longer term trader, or in terms of your outlooks for your trades, well, you might look to place your stop loss behind the 20 period or the 50 period moving average, or maybe another moving average that you like yourself, maybe even a 200 if you want to stay in it for for a long time. But as I said, there's never any such thing as perfection. But let's say in this particular case, we were looking to buy the breakout there. Okay, we've broken out of this particular range, and what might happen is trader might have their stop beneath, well, it could be the 20 or the 50 period moving average, and the trade runs, and actually whatever happens is as the moving average updates, so you update where your trailing stop is, and you would hope that it goes from being a stop loss to being a stop profit. And you can see if you're trading it behind the 20 period moving average, well, then invariably you're taken out of the trade here once price trades back through it again, trade closes the other side. Whereas, if you're trading it on utilizing the 50 period moving average, well, of course, the trade carries on for a much longer period. And, as I said, part of that is about understanding your own outlook, about understanding your own kind of risk tolerance. But for new traders, it can be a useful way to effectively, very simply allow their trades to run. It allows them to have a very simple, almost mechanical rule that, once the trade is placed, you don't move your stop loss, your initial stop loss, until the moving average moves in your direction. And that might be, as I said, you might trail it behind a 20 period or a 50 period or maybe another, right, depending upon your own particular risk profile, your own tolerances. But it can be a very simple, almost mechanical way for a trader to do that. That allows them a way to stay with a trade. Okay, when a trade takes off in a strong trend, as a way and a means to basically stick with it and stuff. And so, if you're new to trading and looking for ways to build simple trading plans, well, that might well be one way that you can utilize a moving average to help you stay in trades longer. One of the third ways you can use moving averages, and one that I particularly like myself, is using moving averages as areas of dynamic support resistance on your charts. So, whenever hear me talking always talk about how, one of your first tasks when you open up a chart is, to draw on levels of support and resistance on charts. And, most of the time we are drawing horizontal static levels of support and resistance, that we see on the bigger charts, or might be like a big round number, like, $2,000 is on gold at the moment. And they're all good and they're effective, but I would call them static because, once they're in, they don't really change a great deal. As opposed to a moving average, which is constantly being updated, even though it's a lagging indicator, it's constantly being updated every time a candle closes. And this is where we can utilize it as a dynamic level of support resistance on your charts. And it's, as I said, it's, one of the reasons for using popular moving average periods like 20, 50, 200 is that they become self-fulfilling nature. And what you actually start to see is that there are lots of traders, whether they be manual or whether they be, algo or system traders, trading around some of the popular moving averages. And this is one of the ways we kind of talk about is it provides an area to which to join an existing trend on one of its pullbacks. So in this particular example, you can see price being in a downtrend, price pulls back here to the 20-period moving average, and then prints here, a very nice bearish pin bar, bearish rejection candle, does it again there. Hopefully you can actually see it there as well. It does it actually quite a few times here on this particular chart. And what we can see is that there is an awful lot of rejection candles being printed around that 20-period moving average before the trend takes its next lurch lower. Okay, there's literally sort of drops again there. Okay, DBD. All right, but this happens. Okay, and this we can see that, and it allows traders to effectively start to combine price action with moving averages in order to be able to give them a very simple trading plan. That you can have a trading plan whereby you are looking to trade trends, you are looking to trade trends and enter them on pullbacks. And one of the ways you do it is by having a pullback to main move average. It might be 20, might be 50, might be 200, and where you see the price action and rejects that moving average. Okay, that can be a very simple, easy way for a trader to operate with that. E-investing, is there a preferred time frame? Not particularly, because what I will say is that the thing about moving averages is that they will move across all particular time frames quite happily, and we see that the moving averages from whether it's a 1 minute chart to a monthly chart. What I would say though is, of course, like every indicator, and in fact every piece of price action, the more data you have going in, the more relevant and useful it is. So my suggestion is that in terms of for let's say swing traders, being able to sort of trade utilizing moving averages as dynamic support and resistance, you'll find if you go through all charts, you'll find areas where that has worked well. But definitely sort of swing trader on the sort of 4-hour daily, weekly charts, you'll find that happens again and again and again, and it can be just I know traders of I work with or mine and stuff who literally will just trade a bounce off the 50-period moving average. That's all they will trade. Okay, that whenever price is in a trend, it comes back to the red 50-period moving average and then bounces off it, printing a rejection candle, of whether it be an engulfing candle or a pin bar or a key reversal candle or a star formation. They will happily, gladly, that is their simple trade setup. All right, and that can work very well for swing trades. But equally, you will see that will occur on 1 minute charts. Okay, that's one of the good things about that in terms of their price and moving averages. They are fractal and they will work across all time frames and all instruments. So I hope that helps you there, Ian. One of the ways you can also utilize moving averages is using the 20-period moving average as an early indication of a trend change. And this is something I utilize myself. It's sometimes I like to use. And invariably, let's get the old drawing tool again. 20-period moving average can be a very useful tool to help you confirm the sort of the change of a trend. And very often I'll say is watch to see how price reacts to the 20-period moving average after recent highs and lows, especially if there's been reversal patterns, which if you're a new trader, you might just still be getting you still getting to grips with recognizing and seeing and understanding those chart patterns, whereas actually the 20-period moving average can be a very useful tool to just help confirm that the sort of the trend is over and the trend might be particularly changing. And this is one good example here, of course, with a blue 20, red 50, green 200 period moving average. The price, here the 20 period moving average has been a bit of a support, but what we're really interested in is that we've been in a nice uptrend, and what happens is we actually hit a level of resistance here, and then what happens is we print a reversal pattern there, which is a double top pattern. Okay, a double top pattern, and lots of traders would be looking to say, well, that this uptrend is now over. But we're expecting price to start to roll over, but we're waiting for confirmation, and actually this is where the 20 period moving average can help a great deal. So first thing is we see that the price trades through 20 period moving average, but then actually what happens is price rallies back up. Okay, starts to rally back up. But what we can see here is this blue 20 period moving average, which has acted as support, now starts to turn. It flips from being support to being resistance. It also turns its way over, and hopefully what you can see is the price action, it can't close back above the 20. Okay, it pushes up to it, but it gets pushed down. Okay, and that is telling us, I'll just clear this trailing, is that that's telling us, well, if you had missed the reversal pattern, or you didn't see it, or you just didn't have confidence in it, this is kind of like giving you the sort of the additional confirmation that that uptrend is over. So if you are still long, you probably want to be getting out. But if you've been on the if you've been sat on the sidelines, this is the opportunity for where price might be about to just roll over and fall down. And actually in this particular case we can see, and as a kind of a interesting additional fact is that very often when we see that 20 act as very strong, dynamic resistance there, very often if price breaks the 50, it's not unusual for it to go all the way to the 200 as well, and that in itself can help you in terms of looking at how to, as possible targets, in terms of your own trading as well. But this is something I use myself, and actually, we're not back next Monday because it's a bank holiday here in the UK, but in 2 weeks' time, on the 17th of April, I think it's Monday, 17th of April, the next Monday Markets Matters webinar, I'm actually going to specifically look at utilising the 20 period moving average, how to best utilise this in this particular style. So be sure to sign up for that, be sure to register, and make sure you come along and you'll learn more about that, that particular little tactic that I will share with you that I utilise myself. So we've got a couple of minutes, so we'll switch across to the charts in a moment. But before we do, just remember, Money Market Matters. We're here, every Monday, 2 p.m. London time. It is going to be an interesting year in markets, and I hope you'll join us to enjoy the journey. With regards to the moving averages, we've talked about that. They are a very popular trading tool for new traders because they're a visual indicator and help smooth out data, which makes things a little bit easier for new traders. It is important to understand whether you're using EMAs or SMAs. There's no perfection. They both have their pros and cons. I use SMAs and one EMA, but it's they are both equally valid as ways of helping you make trading decisions. I personally believe it's best to use common period moving averages. They become self-fulfilling prophecies. We don't want to make this more difficult than it needs to be. With regards to utilizing them for trading, I would not advise trading simple moving average crossovers in terms of just, a moving average crossover. They might be part of as a filter or part of a different trading plan, but just utilizing a simple moving average crossover, works well in trends, but you get chopped about in the in range bound markets. But moving averages are very useful for helping confirm trends and momentum. If you're just building up your skill base and your confidence in terms of analyzing markets, they can also be used to help confirm reversals in markets, as we saw there, the PR20, the power of the 20 period moving average. And as I said, I'm going to be doing a specific session on that in 2 weeks' time. And they can also be used as a guide on where to place trailing stop losses if you're looking for a simple mechanical way to try and stay with a trend that can help you with that. And as a place to enter into trending markets when, if you're in a trend and there is a pullback, and you see the price action bouncing off particular moving averages, that in itself can be a way and a means to enter the trading market and entering a live market. So why don't we have a little look across the live market as we've got into the opening of the US particular session. As I said, before we do that, so please put it in your diary. 17th of April, Monday Market Matters returns. Okay, after the break, and as I said, we're going to particularly just focus on the 20-period moving average, how to utilize that as a way and a means to sort of trade reversals in charts and markets, how to use it as a confirmation for that. So be sure to join us for that. Again, sign up. You can register on the website, and I look forward to being able to share that information with you. And if you have any questions about this session, or if you've got feedback, or maybe there's something you'd like me to look at in future sessions, maybe there's something you'd like to for me to help you understand, that's absolutely fine. We want these sessions to be as useful and valuable as possible. Well, then you can contact us. Now, the English desk number is there, 0207 6500 567, or email englishdesk@activetrades.com, and the guys and girls at ActivTrades will be there, very happy to help you. So why don't you just bear with me one moment, and what I'm going to do is we'll switch across the ActivTrades platform, and we'll have a little look at what's going on with the US markets as they open up. So just bear with me 1 second. Okay, brilliant. Okay, super. So I'm hoping you can still hear me. Hoping you can see the ActivTrades platform now. So this is one of the MetaTrader platforms. We'll also be increasingly over the next few weeks and months just having a look at the combination of ActivTrader and TradingView charts. Okay, which is a fabulous development there for ActivTrades clients. But today, just a MetaTrader sort of platform. I've just got a chart here. This is Nasdaq on the daily. This is Nasdaq on the daily, and as I said, you can see that I have there's a blue 20-period moving average, a red 50, and a green 200. And we can see that I'll talk about it a little bit here. I've just this first chart pulled up. Is that you can see how markets react, okay, around like the 200-period moving average there, okay, it also bounced off the 50, and we can see here that basically, price had moved back, okay, the 20 had been acting as resistance there, but the 50 has been acting as strong support there, all right, and, the 50-period moving average has been, pointing its way up, all right, and price has just bounced off there and has followed and has continued, and the fact that it hasn't come back to the 20-period moving average is just an indication that that of how strong the trend we have been in the Nasdaq, in despite all of the kind of the issues that we have had. That's just telling us there that there's strength, there's particular strength there. So we'll have a look at that at the moment. What I'm going to just do is I just want to see how the US markets have opened. All right, let's just go down to the thing. There we go. We can see there's a kind of 15-minute chart. So I have here, this is the Dow, and this is the Russell. This one here, this is the S&P 500, and this is the Nasdaq. And you see, it's been kind of a bullish open. I often say that when it comes to the intraday trading, markets opening at 9:30 and sort of 2:30 here in the UK. I appreciate we have people joining us from all over the world, so just have to just to basically understand that in terms of just understand that wherever you are in the world joining us. But the important thing is that as I said, I normally allow the sort of the markets for the first 15 to 20 minutes, just allow them to do their own thing. They can be very volatile, especially if what we've had here. Remember, on this Monday afternoon is that A, it's the start of the week. B, it's the start of a new month. C, it's the start of a quarter. But also we had that sort of OPEC news over the weekend. They were going to cut they kind of cut supply by $1 million, a million barrels a day, okay. And of course, there was reactions to that last night when those markets opened. There might be reactions to that as we see markets open here. So we can see there's been a bit of a thrust up there, and what I'd be interested in is that basically we've pushed up to sort of Friday's close, okay, previous weeks high, previous days high, and I would have liked to have seen how market reacts to this, okay. If I just look at that on the 1 minute chart, we can see that there. And one of the things that is useful for traders, or what I say is that the moving averages I have on my charts, I have them at their kind of their thinnest setting, really. So just having them at the thinnest setting. Sometimes I find people will have them really, the kind of the thickest setting possible. Okay. And I have the exact opposite there. And the reason being is that what happens is when people have them really set on thick, I think the eye gets drawn more to the moving average than it does to price. What we have to realize is that, price is king. Okay. Price is key. Price leads the way. That's exactly what we're looking to focus on. Moving averages should be there just to help support us. Okay. Should be there just to help support us. Our focus should always be on price first. Price is king. So, that's why I have them as a finish there, just to help confirm it, but not unsurprisingly, you can see that, this has been in a, this is the 1 minute chart, in an uptrend here. Okay. And, it's just pulling away from that. And that in itself, once price pulls away a lot away from the moving averages, that can sometimes, let's say, be a bit of a reversal opportunity. You can see that's effectively it's an evening star formation there coming out. But that's on the 1 minute chart. All right. As I said, what we're looking for is, I'm just looking for, kind of good opportunities here. Just let's see what we've had. Just looking at that. Yeah. So, this is, intraday, into the electronic contract this morning, coming into the London session there, and then we pulled away. As I said here, we came down here, and this was bouncing off the 50-period moving average here. Okay, and as I said, there are some people who will just quite happily just trade. Once price is establishing a trend, bouncing off the 50-period moving average, and we can see it comes back here, and it's reversing. It reverses there this afternoon, and this is just us looking at the 5 minute chart. Very often, as I said, the 50 can be used as a bit of a fair value, and just that's flat there, just running into the US Open, and then bosh, we can see for yourself how that has just taken off there. So I know that we've got US manufacturing PMI, I think, coming out at 3 o'clock in about 2 minutes time. So of course that will actually have some effect, and so I'll just wait to see that news come out, and then see how it develops. Give it 5-10 minutes after that to see what the reaction to the news and the number is. I'll just go and have a little look at the news and switch on my Squawk Box and listen to that, and see how that particularly develops for us. Okay, so let's just bang. Let's see if we've got, whilst we're here, just want to have a little look at gold whilst we're here, because it's been quite interesting price action there. Here we go. Yeah, just I think I said in my lunchtime slot is that this is 2000 here, big round number. Price had bounced up to it and come away from it. The 50 had held, and it's doing this here, and this is, let's just have a look here. Let's just bring up the drawing tool here, because this is another way that moving averages can help you. Is last week we saw price going sideways, pretty much in gold. What we can see is the price and the 50 and the 20, and I've got the 12 in there as well. When you see price and all the moving averages wrapped up together, that in itself is telling you that the market is consolidating. We'd had a great uptrend here. Okay, a great uptrend there, and then we'd run into resistance, and then, as I said, you can see, whereas we had a couple of great weeks there where price was in clearly an uptrend, the 20 was acting as support, the 50s above the 200, they're giving us clear. Once price starts to get like that, that is just price getting, it's winding up. Okay, it's consolidating. Okay, after those great runs, and now what we're waiting to see is, well, what's its next move going to be? Where is it going? As I said, when prices range bound like here, moving averages as a trigger don't help you, but as an analysis tool to help you just confirm that this price is going sideways. This was all of last week. Okay, it's just price was wrapped up with the moving averages. The moving averages themselves were just wrapping themselves around, and that is another way that moving averages can help you, just to effectively when they're all wrapped up, the price is coiling up, price is indecisive, doesn't know where it wants to do, and so as a good trader, you sit and wait for the next move, the next move to happen. Okay, for the next move to occur. Maybe it shoots back up to 22,000. Okay, maybe it drops to 19,000. Okay, big round numbers tend to be have been quite useful on on gold. But as I said, when the price is just wound up like that, that can be a way for moving averages to help you just to sort of stay on the sidelines and wait until basically the price breaks out and makes its next move, all right, rather than trying to sort of trade in a very sort of consolidated period like that. Okay, there, ladies and gentlemen. Unfortunately, we have run out of time. As I say, time flies when you're having fun. So I apologise for a little bit of the delayed start, just a little bit of technology, sort of gremlins there. Okay, we always have them with the best, best will and intention. Sometimes we just have a little bit of a tech challenge. Okay, everybody has them, don't we? That's the world we live in. But hopefully, you still found that a useful session. I hope that's given you just a little bit of food for thought in terms of how best to use moving averages and also how not to use moving averages. They can be a very useful tool to help you with your trading, okay, just as long as you understand their benefits but also their limitations. As always, I wish you the very best of success with your own trading, ladies and gentlemen. I hope you have a fabulous week. As I said, we're not here next Monday, but we are back in 2 weeks' time, all right, 2 Mondays, and on the 17th, where we'll talk about the 20-period moving average in particular and how we can really utilize that. And I hope you'll join me for that session. Until then, have a great trading week, and I'll speak to you soon, everybody. Take care. Cheers.